I want to welcome everybody back from the break. We're going to start now our second research panel, which is going to tackle one of the big questions on many people's minds, and that is, how is technology changing the financial services landscape? Is FinTech friend or foe? Or maybe a little both? We're happy to have Meg Tahyar with us to frame what the current landscape looks like and to lead our conversation today. Meg is a partner in Davis Polk's Financial Institutions Group and a member of the firm's FinTech Group. Her familiarity with FinTech and bank competition stems from her work providing strategic advice on bank charters, including the OCC Special Purpose FinTech Charter. So please join me in welcoming Meg and the research panel.
Thank you very much. I'm hoping we can get to the first slide here. Here we go. I think it's going to be a very interesting panel with very interesting papers. I think this panel, though, takes the prize. I just want to say this up front, for having the names that are the hardest to pronounce all day. And I'll start as the first. I'm Meg Tahyar. To my left is Tomasz Piskorski from Colombia. And to the left is Tetyana Balyuk from Emory. And then down at the end is Jason, who has a simpler name, Jason Henrichs. But when we get to Q&A, why don't you just all call us by our first names, and things will be simpler. Just to kick us off before the papers, and in light of all the discussions we've had today, I've put up this slide, which I've actually used teaching in a FinTech module that I co-teach at Harvard. And this is just a reminder that FinTech is a word like sports, right? But it does matter if it's rugby or soccer or American football or basketball. And FinTech has a lot of different business models, only some of which we're talking about here today. And if you just look at this one slide, you'll see that we've already identified a bunch of different business models, different regulations, different legal frameworks, different risks to consumers, different benefits. So I won't run through them. I'll let you just bend your eyes over it. But do keep in mind that FinTech is it's an aggregate word, which sometimes helps us and sometimes doesn't. And so here, I think today we're going to be talking about the shadow banking system, peer-to-peer lending, and how that works. And why not just turn it over to Tomasz?
So thanks a lot for the organizers for setting the conference and for inviting us to talk here. So I want to talk today about FinTech and shadow banking because these both trends, the growth of FinTech and growth of shadow banking, are very related to each other. Just want to say up front, a lot of what I'm going to talk today is based on a joint work and a number of papers I wrote with Greg Buchak, Amit Seru, and Gregor Matfos. So let me start with just noting one thing. There has been a very dramatic growth of shadow bank lending over the last few years. If you look on the picture, for example, on the largest private debt market in US, that is $10 trillion residential mortgage market, shadow banks currently account for majority of new loans issued. So they kind of FDIC-insured banks are become minority lender in the largest debt market in US and arguably potentially in the world, depending how you look on that. And of course, this growth really picked up in 2011 and really happened during the period of very significant regulatory tightening experienced by traditional bank. So just a matter maybe of terminology, when I say shadow bank, I really mean non-depository taking institution, the kind of institutions that fall outside of the FDIC regulation. So this trend, this rapid increase in shadow banking, really coincides with the growth of regulation. On the right-hand side, I'm just showing you the number of regulatory restrictions faced by banks in thousands. And you can see that really picked up in 2011. And that's exactly when the shadow bank growth really experienced a very significant rise and when shadow banks start replacing traditional banking institutions from lending. But it's not the whole story. There is also a very important driver of this growth of shadow banks were the so-called FinTech lenders. Why FinTech is interlinked to shadow banking? Because shadow banks were really very early adopters of FinTech technology. And in fact, if you look on the mortgage market, the number one lender right now is Quicken Loans. It's the largest, it's bigger than Wells Fargo, bigger than JP Morgan and other banks. So essentially, a fintech shadow bank now is the number one lender in a $10 trillion market. They originated in 2018 about $100 billion of loans, just that one institution. So this is a very, very different landscape than the one we experienced prior to the crisis. And in the top 10 of banks, besides Quicken, there are four other institutions that are also shadow banks. So institutions not regulated by FDIC and non-deposit taking institutions. So in that sense, if you just look on this picture on the left, and by the way, in other markets, it's not that different. For example, personal loan market is also dominated by shadow banks right now. The kind of a traditional banking sector is largely retreating from many large lending markets. And in Quicken is very well known. You might have seen the commercial during the Super Bowl for Rocket Mortgage. It's essentially an app that allows you to obtain or refinance a mortgage within a few minutes on Saturday evening without going to a brick and mortar bank. And the decision is made literally once you complete the online application, which can take as little as 3-4 minutes. So this sort of dramatic change in lending landscape raises a number of questions. First, what's really the driver of this change? I mentioned that it happened during the period of regulatory tightening, but it's also an important 1/3 of the growth of shadow banking occurred by firms that employ fintech technology. And kind of a broader set of questions, obviously, we've heard about it in the panels before the lunch. What is the impact of this growth on consumers? And kind of ultimately, I think, especially in the institution we are here, we obviously care about implications for financial stability and regulation, and more broadly, implications for welfare. So I'm going to talk about a bunch of papers of us that sort of speak to these issues. So first of all, in terms of the mechanism, the one hypothesis is this growth of shadow banking really occurred because of the regulatory burden experienced by traditional banks following the financial crisis. The FDIC chair referred to it in her talk, essentially saying, well, maybe we regulated the traditional banking sector a lot, maybe they're much more sound, but as a result of that, maybe a lot of lending activity has moved outside of the traditional bank boundaries. And obviously, there's a lot of elements for which this tightening of bank regulatory constraint manifests itself. Think about Dodd-Frank, establishment of Consumer Financial Protection Bureau, changes in Basel III capital regulation, more scrutiny and enforcement, multi-billion-dollar lawsuits related to the crisis area, pre-crisis area mortgage issuance, and so on and so forth. And the idea is that essentially in response to this increased regulatory burden, the traditional banks are essentially cutting lending and retreating from some major markets. So we've actually, just to show you the map, where shadow banks expanded the most, the more shadow banks, the redder you are. This is how it looked like in 2008. By 2015, the US map becomes much more red, and there are really areas when 70 to 86% of loans, and actually areas when more than 86% of loans are done by non-depository taking institutions. So to investigate it a little bit formally in one of our papers, what we did, we essentially tried to see to what extent a retreat of the traditional bank and expansion of shadow banking in a given local market relates to the presence of traditional banks in this market that experience regulatory burden at the national level. So kind of think about this idea of this test is, compared to regions, one has say Bank of America that say experience more regulatory tightening, another has JP Morgan that experience less. Is it true that shadow bank expanded more in areas when banks like Bank of America were more present at the beginning of this expansion? And essentially, we look on three measures of regulatory tightening. One is bank capitalization. We look on areas when bank had to rebuild more of the capital. We look on enforcement and legal risk, essentially areas when banks were subject to more regulatory scrutiny. Essentially, we look on areas when banks present locally were subject to more regulatory scrutiny on national level related to the crisis area lawsuits. And we also look on areas which has more institutions that used to be regulated by OTS. OTS is believed to be a more lenient regulator. So as a result, they experience, in some sense, the regulatory tightening. And essentially what we find out, and again, what these plots essentially say, there's a very strong positive correlation. In areas when banks that were present locally had to rebuild more capital, were subject to more area-related crisis lawsuits. And in areas when you had more leniently regulated banks by OTS, that's an area where shadow banks expand more. And these are where the economic estimates, you have to be a bit careful how you aggregate from this to the aggregate level. But in kind of a regional difference in different specification, what we find out essentially there's very strong empirical support to the idea that a very important driver of shadow bank expansion is the regulatory tightening of traditional banks. The second driver is potentially fintech. As I told you, about a third of the recent expansion of shadow banking occurred by shadow banks employing fintech technology, with Quicken being a prime example in residential mortgage market. So we look also on this, and this is what we find out. In general, fintech lenders save more creditworthy borrowers than shadow banks. It's not really true, at least in residential market, that fintech lenders really democratize credit in a very big scale. They usually focus on kind of prime, middle-class borrowers with good access to internet that really value their time. They focus mainly on refinancing. They're much quicker in originating the loan. That's why they're named Quicken loans. You can get a loan very quickly. And then so much faster than traditional banks in terms of selling these loans. They seem to use different models and data in their loan origination process. Because if you have to approve a loan within a minute or two, they're going to use things like electric bills, your cell phone data records, something we've heard a little bit about in doing the panel prior to the lunch. And what's also interesting, you would think, okay, since they don't have this brick and mortar overhead, maybe they make their loans cheaper and they essentially want attractiveness, they lend at a lower price. That's actually not the case. When fintech lenders expanded in the mortgage market, they're the most expensive lender if you look on interest rate. So there is the so-called FinTech Premium. During the expansion of shadow banks and during the expansion of fintech lenders like Quicken on average charge about 16 basis point higher interest rates than traditional banks and than other non-fintech shadow banks. And by the way, you can throw millions of controls and this difference persists. So why the customers are choosing this bank despite of getting loan at a somewhat substantially higher interest rate? Well, it is really because the customers value convenience tremendously. All customer survey reports will tell you that customers love to close quickly, and the quicker you close, the more value they have. And in fact, Quicken has been ranked as the top lender in US over the last 8 years by customer satisfaction surveys. And the products like Rocket Mortgage, you pay a little bit higher interest rates, but you don't have to deal with all this regular, going to a bank, talking to loan officer, filling some applications. And especially when you buy or when you want to refinance a loan, the time is of essence. Maybe you want to benefit from low interest rates faster, so willing to pay a little bit more for lack of hassle. So think about it as economy premium, or maybe check-in fast lane on an airport. You just want to get, you don't want to deal with all of that. So we essentially did a little bit of a structural model combining a lot of loans just to understand which of these drivers is more important. So we already said that regulation has been an important driver of shadow bank expansion, but also shadow banks are early adopters of fintech technology, and that provides them this competitive edge in terms of convenience, customer satisfaction, and so on. So build a simple structural model. Part of this is combined with a lot of data. What allows us to identify what drives what is that you have really three institutions. You have traditional banks, you have shadow banks that are fintech, and you have non-fintech shadow banks. So by comparing all of them and looking on prices and market shares, you can tease out the relative importance of this. And we did a bunch of counterfactuals, but just to kind of cut it short, what we find out that about 60 to 70% of shadow bank expansion is really due to regulatory burden imposed on traditional banks, especially after 2011. So this, Dodd-Frank, CFPB, Basel, all this combination of these regulatory actions accounts for about 60 to 70% expansion of shadow banks, or in other words, retreat of traditional banks from some major markets. The rest, about 30%, is due to this early adoption of fintech technology. So about 4 minutes left, so I want to close with some implication of that. So first of all, there's obvious implications for financial stability. Fintech shadow banks have no deposit funding base, and they have limited balance sheet capacity. And they're very dependent on ability to save their loans. So this is, for example, traditional mortgage-backed disposition. About a third of loans are kept on balance sheet. Look especially after 2012, because this is the most relevant period. If you look on fintech and shadow bank lenders, vast majority of the loans they make are very quickly sold. And in the mortgage market, they are sold to government-sponsored enterprises like Fannie and Freddie. So they don't really have a warehouse ability. And the concern is that, shadow banks can very quickly shut down in the face of funding problems like the ones we experienced in 2007, where a number of shadow banks immediately failed. Just remember, in 2007, shadow bank market share, for example, in mortgage market was 25%. Now it's 50%. And in the riskiest FHA corner with 3% down payments, more than 80% of loans are currently originated by shadow banks. And of course, another issue is that new lending models have not been tested during downturns, so we have no idea how these lending structures will really perform once stressed. The second thing is, and this is, I'll show you just two simulations in a second. Obviously, the fact that in some major markets, on the largest markets, majority of loans are made by shadow banks should potentially change how we think about regulation, how we think about what kind of data we collect, and so on and so forth. In particular, the significant presence of shadow banks can completely affect the transmission of policies and how economy responds to various shocks. So we have another paper in which we use millions of data and estimate structural model, and that allows us to simulate policy counterfactuals in a market like mortgage market when shadow banks are currently the dominant lenders. Let me show you just two policy counterfactuals. This is what happens to the changing in lending volume in billions of dollars when you change bank capital ratios. So the baseline is at 6%. So for example, look what happens when you increase capital ratio from say 6% to 7.5%. Traditional banks cut lending. As you know, they don't cut lending as much because they can securitize some of the loans, but essentially you're going to exceed a significant drop in lending in response to capital ratio increases. But that doesn't account for the response of shadow banks. The aggregate response, once you take into account shadow bank results, is much weaker because some of that lending with capital ratio, essentially increase in capital ratio, will push from traditional banks towards shadow banks. So looking on this, you could conclude, well, maybe all the shadow banks are doing are just dampen the effects of regulation. So you impose capital regulation without shadow banking sector, traditional banks would cut lending, but some of that lending will it's kind of balloon theory of regulation. You press it here, it's going to pop up somewhere else in a less regulated corner. But it's not always the case. Let me show you another counterfactual. What happens when you reduce conforming loan limits? Just kind of not to go too technical, think about it, downscaling the role of Fannie and Freddie and GSEs. Less and less loans are eligible for securitization. So that will have a very big, so think about going from baseline to minus 25%. Minus 25% means only relatively much fewer loans are qualified for Fannie and Freddie guarantees. What happens? Traditional banks cut lending, but look what happens when you take into shadow bank response, the response is even worse. So in the case of the shocks affecting secondary mortgage market, the presence of shadow bank sector will make the aggregate response much bigger. So just a note to the regulators, don't only look on the bank level data because the shadow banks respond to shocks, including to the shocks to bank regulation, and you need to have a comprehensive view of what's going on. And let me conclude with the last slide. So what are the kind of broader implications? So one thing is, obviously, since we have more shadow bank sector, FDIC may be less worried. Because, in the limit, if 100% of loans are made by shadow banks, you don't worry maybe about risky lending by banks. But of course, banks have indirect exposure to warehouse credit lines and so on. But remember that we're just shifting taxpayer risk from one bucket to the other. We just move a lot of risk from FDIC to government-sponsored enterprises. And by just doing this shift, it's not clear what we really want from the consumer welfare perspective. The second point I want to say, the point that discussants in the session prior, the presenters discussed a lot prior to the lunch, all this implication of big data collection, the fact that shadow banks are relatively unregulated and serve least credit-worthy borrowers, that's warrant more attention. And finally, let me finish with the last point, the traditional bank response. Shadow banks were early adopters of fintech technology, but traditional banks are starting to catch up, and it's kind of interesting to see where this game and competition how it will evolve going forward. Thank you very much.
So thank you very much for inviting me to present. While we wait for the slides, just a very brief intro to the paper. So my paper will be looking at the implications of fintech for borrowers, and specifically in terms of the credit. Do I have to click on it? Oh, okay, awesome. So in terms of the implications of fintech for borrowers in terms of access to bank credit and subsequent change in the borrowing patterns of borrowers. Now, if we look at the fintech landscape in general, we see that most fintech innovation is happening in two big sectors, which is payments and lending. And within the lending landscape, a lot of it is happening in consumer lending and also small business lending. So if we talk about the consumer credit market, this is one of the largest credit markets and most important ones, with around $4 trillion US dollars. But this market has a number of imperfections, and those imperfections make credit scarce and costly for consumers. So we're talking about high interest rates, specifically for credit card debt, credit card companies often pulling borrowers of diverse credit quality with similar rates, and also frequent credit application rejections, not only on credit cards, but also for bank credit. Those imperfections are caused by a number of different frictions, including high transaction costs, specifically for debt refinancing, asymmetric information between lenders and borrowers, possibly imperfect competition. So these were the different explanations that were put forward in the literature, in academic literature, and specifically I will focus on information frictions. So this market has seen many fintech lenders enter over the last decade. And now, if we look at the share of fintechs, it comprises, according to TransUnion, around 30% of the personal unsecured loan market. So fintech is big in consumer lending. Fintech companies possibly see opportunities for profitable entry and for mitigating those frictions. Now, the entry of fintech is even more, it's very fascinating, but it is also a little bit puzzling, because if we look at all the evidence in academia, the emergence of financial intermediaries is often explained by the ability to mitigate all of those frictions. So why does fintech have an edge in how fintech companies are different from banks? That's a big question. Fintechs differentiate themselves in lending by being able to provide more convenient, faster, and cheaper service to consumers through their online presence, automated underwriting and automated decision-making, and possibly favorable regulation, as we have just seen. Also, many fintech companies claim using superior algorithms by using machine learning and alternative data. However, it is an empirical question of whether this is the case, whether what they're claiming is actually true, and if they are indeed can mitigate some information frictions, what are the implications for borrowers? If fintech can relieve information asymmetry in the consumer credit market, borrowers should benefit through lower rates and through more access to credit. And the big question is, how will that change the banking landscape? And what are the implications for access to bank credit and for demand for bank credit? So what I'm doing in this paper is asking basically a simple question: how does fintech lending affect bank credit? And I'll be looking at two things. I'll be looking at supply of bank credit, but think about supply in my case not as an aggregate supply, but as access to credit for those people who are successful at getting a loan from a fintech lender versus those who get rejected. So I'll be looking at two types of borrowers: one borrower who did get a peer-to-peer loan, another borrower who applied for a loan but didn't get a loan. And I'll be looking at the outcomes for those borrowers. And another sub-question of this big research question is, how does borrowing from fintech change the consumer borrowing patterns from banks? So just a brief introduction into what peer-to-peer lending is. So one of the major fintech innovations in consumer lending is so-called peer-to-peer loans. So these are online platforms that operate as two-sided matching markets. On the one side, we have borrowers who request a loan online, and on the other side, we have lenders who screen, evaluate, and crowdfund loan applications. Over time, these platforms have evolved, so many of the investors on the platform are sophisticated institutions rather than regular people who invest in consumer loans. However, in the lending by retail investors, we still have this gradual process of crowdfunding, which I use in my paper for identification using some fairly advanced techniques such as regression discontinuity design. And I refer the interested listeners to my paper because here I want to focus more on the results and intuition rather than on the technical details. But if you're interested in more details and more robust empirical tests, please have a look at the paper. So a few things to note here is that Here, most of the information now is so-called hard data. So whether those platforms started by including a lot of alternative soft information initially, such as borrower pictures, such as additional requests for information about utility bills. This information is not available in peer-to-peer lending anymore. So we're mostly talking about credit bureau data, hard data. Another important detail is that those platforms mostly originate small consumer loans that may be costly for banks to originate. APRs are really granular. So if you look at the pricing is granular, and APR range from 6.4% to 36%. So what is innovative about peer-to-peer lending? There are two features of peer-to-peer lending platforms that are innovative compared to how banks can do it. So one is, this is basically now a new public market for consumer debt. So consumers are evaluated not only by the platform, and not as opposed to being evaluated by just one bank. So they are also evaluated by many investors who run their own sophisticated algorithms on the data that the platform provides. So there is this data transparency, and the platform does its own evaluations, plus investors evaluate those loan applications. And this has implications as to the screening that is done on those platforms, and possibly has implications for pricing of those loans and for credit adjudication decisions. The second important distinction is that everything is automated in peer-to-peer lending from one end to the other end. And the implication of this innovation and automation is lower screening costs. So we may see that origination of credit becomes less costly, and that may translate into low rates for borrowers. Again, this is an empirical question whether it does or it does not. So let me show you some key results, a summary of the results, and then I'll go a little bit more into detail in terms of each of those. So what I find in that project is that banks increase access to credit for those borrowers who get a peer-to-peer loan. The increase is larger for those borrowers who are more likely credit rationed ex ante initially before taking the loan applications. And specifically, I look at borrowers who have short credit histories and who have low FICO scores. I also look at whether the effect is on the intensive versus the extensive margin, and I find that most of the effect is coming from existing lenders. So it's not like borrowers get new credit lines. It is existing banks, existing lenders who extend credit for those borrowers. On the demand side, I find that the peer-to-peer lending does seem to change the borrowing patterns of consumers. So I look at all borrowers in aggregate on the platform and on average, and I also look at so-called marginally funded borrowers. So these borrowers who are marginally funded, they were just able to make it in terms of the crowdfunding process on the platform. I use data from. There is a cutoff in terms of the funding amount. So if you're below the cutoff in terms of the funding rate by investors, you do not get a loan. If you're just above, you are able to get a loan. So when I look at those borrowers who are really close to the threshold, I call them marginally funded borrowers, and these are a better comparison empirically. So what I find is that most borrowers, they do refinance their credit card debt by using a peer-to-peer loan, but those marginally funded borrowers do not refinance their debt. They consume the peer-to-peer loan. I find that some of this, not all the proceeds are used for debt refinancing. Much of it is consumed. So the total debt of all borrowers goes up. But importantly, I do not see an increase in delinquencies for those who borrow from platforms. So the results are consistent with fintechs being able to relieve information frictions for borrowers. Let me go into more details. So who borrows from peer-to-peer lending platforms? So this graph on the left shows the distribution of the FICO score in blue for peer-to-peer borrowers and in red for the general population. So you can see that most of these borrowers are prime or near prime borrowers, but the distribution is more skewed towards the riskier types. If you look at borrower characteristics, the table on the right, you see that an average borrower on the peer-to-peer lending platform has fairly good credit profile, good credit scores. The cutoff is due to the underwriting criteria of platforms, so you need to have a FICO score of at least 640, 660 to be able to be eligible to apply. But also you can see quite good credit history. So this is not like a young novel borrower generally, or not a young immigrant. But if you look at the total debt of those borrowers, that total debt is much larger than the average total debt in the economy. So these borrowers are very highly indebted. On the median, they're not home borrowers, homeowners, so they may lack collateral to get a home equity line of credit to refinance credit card debt, for example. And strikingly, their credit card utilization is really high. So this suggests that although peer-to-peer borrowers can be low risk, but there is some evidence that they can be credit constrained because they're using their credit card so aggressively, or they can be present biased because they prefer using credit cards to borrow. So for those borrowers, if we think theoretically, there can be two different predictions in terms of the supply and in terms of the demand. If peer-to-peer lenders are screening borrowers loosely, then eventually borrowers should overborrow, and banks subsequently should decrease access to credit for those borrowers because of burden of repayment or because of moral hazard. In contrast, if obtaining a peer-to-peer loan is a signal of creditworthiness of those borrowers, then banks subsequently should increase access to credit for borrowers, relying on the signal from the platform. On the credit demand side, the predictions depend on which specific frictions can those platforms mitigate. If they mitigate credit rationing, which is denial of credit, then less creditworthy borrowers should get more credit. If these platforms mitigate so-called pooling, where borrowers of diverse credit quality get similar rates, then we should see borrowers of high credit quality refinance more of their debt. So these are the results. So first of all, I find higher access to bank credit for those borrowers who successfully obtain a peer-to-peer loan. So the increase is on average roughly $1,000 plus. So this is a net increase due to the peer-to-peer loan. If you control for things like credit score, income, employment status, debt-to-income ratio, and this is a plus around 2.6%. For marginally funded borrowers, I also observe an increase. The increase really varies across borrowers. So those who have short credit histories have a larger increase. For example, if you have just 1 year of credit history, your credit increase will be around $3,000. If you have 20 years of credit history, your increase in credit will be around $900. So here we're talking about credit limits on revolving accounts, which I use as the primary measure for the supply of credit. If we look at borrowers with different FICO scores, so this graph shows you the economic magnitudes of coefficients for microaggression analysis. The higher the coefficient and the more significant coefficient, the higher the increase. And you see that most of the increase comes from lower quality borrowers, so those who have FICO scores below 7,000. Most borrowers refinance expensive credit card debt out of peer-to-peer loans. So now I'm looking at balances on credit card debt. And the decrease is around 7.6%. And if you look at this graph, it appears that the higher quality of a borrower you are, as measured by the FICO score, the more of credit card debt you refinance. Lastly, when I look, the question is, if you take on more debt and then you get more access to even bank debt, are you now over-borrowing and defaulting more often? So I do see that the total debt of peer-to-peer borrowers goes up after a peer-to-peer loan, but I do not find evidence of increase in delinquencies. So how do we interpret the results of this study? So the results maybe seem surprising because we know that banks have been in the space for decades and presumably have experience and even more data, such as private data, to screen borrowers precisely. However, it is important to note that there are some important distinctions between banks and peer-to-peer lenders, including feedback from investors on peer-to-peer lending platforms, including a different algorithm that they run, and specialization of FinTech in the space. And one evidence of this is FinTech bank partnerships. Some examples of these you can see here. So banks often outsource screening to FinTechs and trust FinTech screening algorithms by being themselves investors in peer-to-peer loans. So there are 3 channels in which a peer-to-peer loan can be a valuable signal for banks, which may be superior algorithms or complementary algorithms, or even peer-to-peer lenders screening those borrowers that banks did not find profitable to screen. So this slide basically summarizes all the findings. I'd like to stress out some avenues for future research. So the question is how that affects banking and how do banks respond? And the bottom line of the project is, and the key takeaway from it, is that FinTech lending mitigates financing frictions for borrowers and results in information spillovers from FinTech to traditional banking. Thank you.
Nice work. So for those who are regular listeners of Breaking Banks, which I'm sure all of you are since we're the world's largest fintech podcast, my wife and I have this little game, well, it's her game. She tries to guess what I'm speaking on based on how I'm dressed or what I'm packing. And so on Monday night, she was looking, and it's gotten relatively predictable over the last 10 years. She goes, regulator suit. It's like, yep, this is the standard regulator suit. She goes, you have on the innovation socks, not your fintech socks. Those actually have sharks on them. But then the tie came out, and she paused. This actually gave her, and I didn't realize what a big deal it was until this morning. She looks at the tie, and she was completely befuddled. And she pauses for a second and goes, I've got it. You're going to a funeral of a banker that was killed by regulation getting hit by innovation. She may have looked at my slides because it's not actually too far off. So I want to pull out actually 3 themes from what these papers had in terms of why did we see the rise of shadow banks and alternative lenders. 1 was technology, 2 was data, and 3rd, no surprise since we're at the FDIC, regulation, right? The evil enemy, regulation. I want to unpack this a little bit because, while it's easy to point to this as the story, I think it actually obfuscates something deeper and more significant that we need to address in how banks are addressing the new market and the bank-fintech partnerships. So on the technological front, right, I love the question that was brought up at lunch around the cores. And the reality is, we work with hundreds of community banks. Actually, with our partnership announced today with ABA, we're working with all of their community banks. But we tend to approach the world this way. We start with our tech. We go to the core. And the core is more than just that general ledger anymore. It is not just where we store the transactions. We're buying a whole host of services. And with consolidation, ever more services are getting locked in. And so our core provider is actually beginning to determine our tech strategy. And our tech strategy and our tech stack is actually beginning to determine what our corporate strategy is. And our corporate strategy is driving what products we offer. Does anyone see a problem with this? Right? It's a bit of the tail wagging the dog because what's missing? Where's the customer? The rise of fintech and so much of fintech is they start with the customer. They figure out what is the problem they have, how can they solve it, and that determines their strategy. Their strategy determines their tech strategy. And the last piece is, I am going to go get my technology in the most efficient and effective way to go serve that. So let's talk for a second about data. And I love this quote from one of the banks we work with. We were doing a roundtable, a bunch of bank CEOs and community banking, and we're talking about data. And his aha was, if you look at the tech companies, what is the asset? What is the new currency, as Yelena said? The currency is data. He goes, we think of data as an afterthought. We're so focused on our products, we don't look at what we have. And I loved one of the elements that came out of all of the papers that were on our panel was the banks have much of the same data. In fact, I would argue they have even more data than the fintech startup. I can tell you, having run a fintech startup, the ability to get customers and therefore data is exceedingly painful. The problem is we don't update our models and our approach in how we use that data nearly fast enough in the space. And let's talk about regulation, right? We have to talk about, the problem is regulation, the problem is regulation, the problem is regulation. The number of times that I end up talking to banks saying, we want to be innovative, but the regulators won't let us, right? And there is some truth to that. Regulation is both confusing and getting ever harder in how it is interpreted, but it's really the interpretation and the level beyond that the real problem comes in. Because we start with, here's the regulation, it's written down. Abstraction number 1, well, how is it getting interpreted? Abstraction number 2, last exam, what did they say? How did they interpret it? What kind of discussion do we have? And the most dangerous abstraction of all is, now what if we put into our lore of this is what regulation says? It's unbelievable to me. I still find myself on occasion having arguments about whether you need a signature card to open up a DDA, right? And it's like, it's in the regulation. The question is, well, point to the regulation. Well, I can't. Well, it's the lore. We've developed this regulatory rigidity because we've been regulated for so long and in our approach. And that's one of the biggest assets that the fintechs, whether they be a startup or someone coming from an adjacent space, have, is they're starting with a clean slate. They don't have this muscle memory pulling them in the wrong direction. So I love Tomasz's point. Do shadow banks fill regulatory gaps? I would actually argue, yeah, a little bit, but there's a deeper problem. The bigger problem is, what job are we hiring financial products to do? Now, we as bankers and those in the industry, we're very clear. We talk about making a mortgage. The customer doesn't want a mortgage. The customer wants a house. The mortgage is a way to get there. And let me tell you a story in an adjacent industry. It's about cleaning your floors. Who values a clean floor? More of you should be raising your hand. I know it's true. Turns out it is a very large segment of the consumer goods industry. It also is a very stagnant portion of the home goods industry. And no matter how much money was poured into innovation to get cleaner floors, better mops, and the like, it was not growing. So P&G hired the design firm IDEO, a bunch of anthropologists. You wonder what anthropologists do when they graduate and couldn't find a job? They go to IDEO. And they go study people, and they found, yes, it is true, people really do value a clean floor. Why? It kind of shows this is our house and our lifestyle. It's a personal judgment. But they also found that the very act of cleaning your floor gets you dirty, right? Think of the tension between those things. In fact, the cleaner you want to make your floor, the dirtier you have to get down on your hands and knees and scrubbing, right? So who has one of these in their house? It does not do a perfect job at all. But you know what? My 2-year-old can clean up the golden retriever hair with that thing, and it looks pretty darn good, and she's not dirty at all. In fact, I love she does it 2 or 3 times a day, right? And so you could say, okay, but that's the consumer goods. That's not us. We're banks. Well, let's talk about peer-to-peer payments for a second. A very mature segment. Think of all of the ways that I could get Meg money. I can give her cash if I had it in my wallet. I could send her an ACH. I could write her a check. I'll send you a wire, depending how much I owe you, how much drinks are tonight. Oh, there's Venmo, right? This stagnant category. And Venmo came and said, wait a second. Payments are now largely digital, except there are these crazy offline things that happen called people being social, where they want to be able to pay each other. Boom, Venmo creates an entire growth phase in one of the most stagnant parts of our industry. So we're not immune to this. I also want to call out something that Tetyana said, which is the innovation in P2P was not really product innovation, right? It is a distribution innovation. And have people seen this before? In the background, it is actually the Wells Fargo site, and these are all of the competitors that are going. CB Insights puts this out. It's called the unbundling of the bank. And I've actually quit updating it because you can't actually even see Wells Fargo in the background. So this is my slide forever on it. Right? So this is the competition we're talking about. Wrong. It looks that way. But we're really just putting digital lipstick on the pig of a whole set of analog processes and problems we're trying to solve. Yet Quicken has done a much better job of pulling in data. They make it so you can do it overnight. They make it fast so you don't have to answer to your wife. Have you gotten the mortgage yet? Have you gotten the mortgage yet? I haven't had time to do it. It's like, yeah, I did it last night when you were putting the kids to bed. Right? They solve part of the problem. The next level down, though, is where things really start to get interesting. And this is where we've not even begun to tap the amount of change that is brewing and what's going to happen. Because once we start innovating at the tactical level, when we're changing not just the interface that the customer sees, but the way we do things. We're seeing parts of this with algorithmic trading and automation parts, but we go even deeper and deeper into the tactical level, which eventually enables we begin to innovate at the strategic level. This is where the real change happens within our industry. And we get blinded by the fact that we see all these digital competitors, whether it be the fintech startups or others, but we're so focused on digitization in the UI, we're missing the things that are going to cause very deep change. So Meg and I have a little bit of a bet on this. I want people to vote honestly, because I will call on one of you as the honesty test. Who has read, at least the paper level, Clayton Christensen's Innovator's Dilemma? What did I tell you? Look at that. How many hands are up? So last night in the cab, Meg is like, I expect every hand to go up. So let me give you the very short version of the Innovator's Dilemma because it's very relevant. I was supposed to have 20 minutes, just for the record, and you started at 15. I'm watching you. All right, so Clayton Christensen, Harvard Business School professor, wanted to understand why do incumbents fall off of the top of the heap, right? If you think of the king of the hill, you would think the king stays up there forever. In fact, the pace of somebody being at the top of the Fortune 100 is actually shortening. And this just like confused him. This was even 20 years ago when he started. He said, but they have customers, they have revenue, they have profit, they have economies of scale, distribution channels. That customer intimacy leads to more innovation. Why is it that that time frame gets shorter and shorter? And what he found is we have a tendency to over-innovate in what we already have. We keep packing more stuff into the products we already use. My great analogy of this is Microsoft Windows. Who like me is thrilled every time they do a new release, change all of the UI so they can just shove more stuff in, and it's for the love of all that is holy, all I want to do is do a mail merge, and now I can't find anything back. And they're like, oh, but look at all the additional value we're giving you. No, they're not. There's actually value in simplicity in saying, as your needs are changing, there's somebody who comes along and says, oh, you know, I don't meet your needs today, but the competitive advantage of a startup is called desperation, which is if I actually can't take the products I have today that you don't like and turn them into products that you're willing to pay me for, I get wiped out. Right? I don't have the benefit of complacency, which is existing customers paying me. And so they very quickly begin to develop along that line. And guess what? They're further up the curve. And now the mainframe of the world goes, oh man, I can't compete with the microcomputer. Now people can actually, without going down into the basement and go seeing the holy seer in the IT department and saying, please, can you run this analysis for me? They can actually do that at their desktop. And then it was actually the CEO of DEC, the leader in microcomputers, famously said, it is a horrible waste of computing power to actually put a PC on every desktop, right? Now, the only thing left of DEC is actually their credit union, which I find very ironic. And then Bill Gates made the same mistake, though, which he said when Jobs came out with the first tablet, the Newton, he laughed. He said, that's foolery. People aren't going to use a tablet. It doesn't even have a keyboard. You can't do that. Guess what? PC's market share is falling. Now most of us actually do it on that little phone. Now, here's what it looks like in our industry, unfortunately. And the things we point to are the technology, the processes, the people, the culture, the regulation. That's what keeps us in this innovator's dilemma for financial services. But the problem is, customers' expectations don't stop. They keep going up and to the right. And the bigger the tension gets, the bigger the change that comes right after that. And what we're seeing right now is a tremendous release in that tension. Over $100 billion has been invested in fintech startups over the last 5 years. The problem with this slide is that is the tip of the iceberg. The challenge is the largest and savviest of the bank players have changed their game. When you listen to how Chase and Goldman talk to Wall Street now, they don't say I'm a financial services company, and they're not just paying that lip service. They're investing massively in the technology, right? They're doing it through taking on new strategies. Goldman Sachs and Marcus. Chase saying, hey, we'll actually go partner with Apples and Amazons and do new things. They're doing acquisitions and acqui-hires and making massive investments. And then on the flip side, you say, well, wait a second, what about the Facebooks of the world? They're playing with payments. Starbucks is actually now a major holder of deposits with zero cost of funds thanks to their loyalty app. Everyone says, oh, Amazon doesn't want to be a bank. No, Amazon doesn't want to be a bank. But the problem they're solving, the job that their customers are hiring them to do, is they want to buy stuff. And Amazon says, if I need to provide you a banking service, whether I build that, partner with it, more likely keep partnering, I am going to do that because the job you're hiring me for is, you're not looking for a microloan. You're just looking to be able to get diapers between paydays. And they're going to solve that problem for you. And that's where the biggest change, the change in the business model, is coming in our industry. Now, we get very hung up on this idea of we look at our core strategies and tactics, the way we run things today. And that does a really good job of extending the line, right? This is the improvement in our efficiency ratio. This is, increase in dividend or consistency of dividend. And then we start to look at what are the ways we can partner with the fintechs, right? Those are the things we're going to help bend the line. But what we miss is what's coming next are those who are about to jump the line and fundamentally change the game and the approach we're taking. And unfortunately, this is the banker my wife was talking about, who's now feeling this. We're caught between a dynamic landscape. And when I say fintech here, I don't mean a startup. I mean the entirety of the landscape is changing at an accelerating pace. But on the flip side, we have a duty to the system for safety and soundness and to our customers and consumers about dealing with this highly regulated environment, which exists for a very good purpose. And that's the tension we need to figure out how we solve. And the problem is, the longer you wait to try and solve that, the faster the train is moving before you try and jump on, the harder it is. The problem grows exponentially on the back end. So in Clayton's world, we look at sustaining innovation versus disruptive innovation. We're just right here. The really big things are just about to happen.
So thank you very much. We now have about 20 minutes for questions. And I hope, and I urge everybody to read The Innovator's Dilemma. I certainly lost that bet. I want to kick off the questions by asking Tetyana a question. And it comes a little bit from the Innovator's Dilemma frame. If you think about the credit card operations of the large financial institutions or the standalone credit cards, they're charging about 22%. And that's unsecured personal lending. And if you assume that the fintech lenders are mostly not at the 36%, but they're mostly below 22%, seems to me and it was very interesting what you said about how it's substitution for credit card debt, because it seems to me that the large financial institutions don't have any incentive to provide unsecured small dollar personal loans at, say, 12 or 14%, because they're going to cannibalize their existing credit card operations. And that's kind of straight out of the Innovator's Dilemma playbook. So I just wonder what your reaction is to that.
So yes, thank you for the question. So before I answer the question directly, let me just give you a sense of how the distribution of those rates look like. So if you look at this distribution between 6% and 36% APR, the average is around 17 to 18%, which is lower than the 22% that you mentioned. But also the distribution is a little bit skewed towards the left, meaning lower rates even than that. Of course, it seems like in terms of the borrowers who borrow from fintech, there is a mix. So some borrow at higher rates, possibly because they cannot get credit elsewhere, so they are okay with having credit even at a higher rate if someone gives them credit. Some of them max out on their credit cards in my sample. So there's definitely a mix. I can't argue that the channel is that some perverse incentives of banks. This may be possible. There are many different ways in which banks will be reluctant to change their pricing. There are many potential reasons, including imperfect competition, including fear to cannibalize operations that you mentioned, including just inability to run a more precise model. So we don't know for sure based on my study, but what my study indirectly reveals is when you have access to fintech and you get a loan from fintech, if you're more creditworthy, you're more likely to refinance debt and you will refinance larger amounts of debt, which kind of gives you indirect evidence that maybe before you were pooled with other borrowers of lower credit quality, and if you were high credit quality, you effectively subsidize those low quality borrowers, and fintech can change that.
So their microphones are up in the room if people want to come forward and ask questions. And while we're waiting to come forward, Jason, I would really like it if you would tell me the story you told me last night about the gambling app on the phone and battery, because that blew my mind yesterday before some of the earlier papers also blew my mind.
We were talking about a startup in Africa where a very large portion of the population has no credit history and credit score due to it's virtually non-existent. So some of the non-bank lenders that have entered the market, their primary device for accessing the internet is this, and they started looking at, not really sure what they were digging for, but the difference in credit quality based on what you had on your phone and how you used your phone. So, there were some earlier hints of that, but there were two in particular that really stood out to me. One is if you never let your phone completely run out of juice, you actually become a much higher credit quality. And so then the next thing they turn to, right? Like things non-intuitive, but once you see, you're like, oh, I can get my head around that. There's a level of responsibility. If this is such an important device and what I do, I can see my way to that. And the second thing they brought up was looking at if you have a gambling app installed, right? Now,
that got a reaction.
Yeah, I got the reaction. So I love doing the polls. Who thinks the president says the gambling app makes you a better or worse credit risk? Better credit risk? Worse credit risk? Okay. What if you have the gambling app and you never let your phone run out of juice? It turns out you are the best credit risk, right? Even better than the person who doesn't run out of juice.
So we'll come back to Tomasz in a moment. Sir.
Thank you. Thank you for the wonderful presentation. My question, I'm Shigeru Shimizu, Bank of Japan. I have a question to Tomasz. One of your slides showed that the FinTech Premium, which I think the FinTech companies are lending at a higher rate than the average banks. My question is, do you think that's something permanent or just temporarily? Because I think one of the reasons you raise is like the people like the quick response by the FinTech companies, FinTech lenders, but it's maybe just temporary things that the FinTech lenders are targeting the very kind of riskier for the refinancing. So that's why they're able to lend at a higher rate. Or do you think it's more of a permanent?
So I did look on a recent data, and it's moderates over time, and the FinTech Premium gets compressed. I think there are really two reasons behind them. That first, there was a refinancing boom that is dying, so the refinancing market becomes more competitive. Part of that, because of programs like Home Affordable Refinancing Program, very low interest rates, and legacy mortgages that want to refinance, you could command this premium because traditional banks were kind of overwhelmed and dealing with this regulatory oversight. Now when the refinancing, there's fewer people willing to refinance, it's more competitive market. Also, banks are catching up. There's a number of traditional players that actually try to replicate the same app. So I think it's probably not gonna, in relative terms, persist at this level. My very recent data actually shows that it's compressed quite a lot. But I think it speaks to what the main advantage of this application is, and it comes back to the discussant point, is that that's really it's not so much necessarily about cost savings, but obviously it saves you the effort to go to traditional bank branch, or it may allow you to refinance quicker, which has also monetary value, but it's really about the convenience and experience. That's what customer wants. People want to be able to refinance loan at 3 a.m. on Sunday
But
evening.
according to the former presentation, that's not cost adjusted, right? So that it's a higher rate, but in the downtown, there might be a cost. I mean,
Sure.
the delinquency might higher. Okay, thank you.
Sir.
Hi, this question is sort of for the town. You mentioned that one of the some of the customers you looked at didn't qualify for the peer-to-peer loans, right? So they are obviously too risky for the price point. What happens to them? Do we ignore them? Do we not care about those customers? Why do we set an arbitrary cutoff?
So I mentioned the cutoff that the lenders set. I do not know what happens to those customers who do not reach the cutoff, who are below 640, because that's not in the data that I get. And my results basically focus on the data from one lender, so that's why I use those who got rejected as a counterfactual. So all of the results are basically if you get a loan versus if you do not get a loan. So your increase in bank access if you get a loan versus if you do not get a loan. That's my counterfactual. That's a good question. What happens to others? Are there any spillover effects to others? Or do others get access from other sources, or maybe banks respond and they change their pricing to all categories of borrowers? That's a really good question. I don't think I can answer that question with my data, unfortunately.
Unfortunately, I can tell you today they end up with payday lenders, right? And that's part of the vicious cycle that goes on. Why is it unfortunate? Well, so we do a lot of work with Center for Financial Service Innovation. One of the things that they've shown in their financial wellness report is when you get down to the very lowest of that and you end up at the payday where it can be very punitive and the amount you end up paying in debt becomes such a vicious cycle, the likelihood you can pull yourself out of that with what starts as I'm going to do it one time to cover one thing. A lot of times that it's either I think the number one and number two are a medical event, and the second is a car that prevents you from getting to work. You never pull out of that cycle again.
I mean, it's an open question how much the banking sector or the financial sector should be at the front lines for dealing with what are problems with health coverage and income inequality. And I realize those questions are very complex, but I always wonder why we're asking the banking sector to solve those problems rather than asking society as a whole to solve them. Sir?
Yes, Dennis Santiago again. This question is primarily for Tomasz, because you had a chart in your presentation that showed that shadow banking accelerated by FinTech technology has the effect of shifting and being vulnerable to downturn risk from the shifting of assets, particularly mortgage assets being sold into the GSEs. So we're concentrating risk into GSEs as we are going along. Now, I asked this question because in 1991, I made the mistake of installing a salvaged piece of Drexel Burnham Lambert technology that did structured financing, mortgage securitization, packaging at a tiny little bank in Pasadena, California called Countrywide. How do we know we're not building another black swan?
So I think this is a significant concern. So shadow banks do not have a very deep balance sheet capacity. They have very shallow pockets. They are almost optimized to fail in the crisis. Because when Bank of America had problems, Bank of America, that's one reason why it pays to pay your lawyers. They acquire Countrywide with all the legal liabilities, and as a result end up paying tens of billions of dollars of fines. But they were able to pay these fines because they have other sources of businesses. So in some sense, they have equity that could be seized, that regulators could go after in the crisis. Companies like Quicken and others, they have very limited capital. They have relatively limited capital. So in the crisis, they will probably shut down very quickly. Now, you could argue that since most of the mortgages they made, vast majority is guaranteed by government, maybe this risk is not as big because this paper has implicit. So it's a taxpayer risk, but maybe not a financial stability risk. I still think there is a considerable financial stability risk on two accounts. First of all, these shadow banks are often financed with credit lines obtained from traditional banks, so they can just withdraw them in the crisis. Secondly, the issues of representation and warranties. So you could imagine that there's a concern about the quality of the origination standards. There might be the concern that, the Fannie Freddies of the world would go after them, or they won't be willing to guarantee this debt going forward. So the problem is if we have a sector like FHA, when more than 80% of mortgages, this is the most vulnerable sector of borrowers, low down payment, high minority share, their shadow banks pretty much are the only lender right now. This sector can shut down probably within few days during the major crisis. And then it's not obvious traditional banks will be willing or even able to pick up the slack, given that they pretty much exited this market, including the experience, they don't have branches focused on that. So I think there is a considerable risk that we are sort of repeating the similar situation, very short-term financing, limited capital, very dependent on securitization, arguably with government guarantees, but still potentially quite prone to a sudden shutdown.
And so are we making that better or worse by the GSC reform?
So, in terms of, I'm old enough, so there's been a lot of discussion about GSC reform. It proves to be politically very difficult because these are typical voters, and for a variety of reasons, often political affiliation gets superseded by what the local voters want or what the local voters think they want, and the lobbyists and so on. I think one concern, the simulation I showed in the presentation, shadow banks are very dependent on existence of government-sponsored enterprises, which actually makes the reform of housing finance market so much harder. Because suppose, take a market when, like FHA, 80% of loans are essentially guaranteed by government, or in other mortgages, more than 50% of loans are issued by shadow banks. Suppose now you want to downscale GSC, all these lenders will essentially stop lending because they don't have balance sheet capacity to keep it on balance sheet, and traditional banks allocated their balance sheet capacity to other activities, underwriting, corporate credit, and so on. So in that sense, if you're just looking on traditional bank response to the GSC reform, one of the common GSC reform is to lower the conforming loan limit. So make less and fewer loans eligible to sort of bring back the private market. That would cut the traditional bank lending, but the aggregate decline in lending will be even bigger because the shadow bank is so dependent on this financing. Now, of course, you could argue that maybe we could revive private securitization market, and then the shadow banks can still use it. But our experience from prior to 2007 is not super encouraging in this regard. And my discussion with investors, with Association of Mortgage Investors, were unwilling to come back and fund private securitizations under the current legal structure. So if we really want to downscale GSCs and have return of the private market, we have to bear in mind that the majority lender in the market right now is super dependent, is hooked up on this financing. So if we would have cut it right now, it would be so much harder to keep the lending volume, unless we could at the same time encourage private securitization market and measures, which proves to be very challenging over the number of years.
It's quite interesting, the label shadow bank, right? Because that's a loaded term, and we struggled with this a lot when we were writing the textbook. Should we use shadow banking as a term? And I see that the FSB in recent reports has started using a much less catchy phrase like short-term wholesale financing markets. So. But I think that the term's so catchy, it's here with us to stay. So we ended up using it in the textbook, but trying very hard to define it. And it's actually broader than what the fintech lenders. But I think the risks you're talking about, because this banking isn't happening in the shadows, right? It's happening way out in the open. See a lot of nods. But the risk you're talking about is, in fact, it's interconnections with the rest of the financial sector. So Quicken is financing itself through warehouse loans or through bond offerings or for other things. And so the warehouse loans are coming from traditional banks, right? And so it's, in fact, because the question is, so why don't they fail? Why do we care if they fail? Aren't they safe to fail? And I guess the question is, are the interconnections with the traditional banking sector so large that they're not safe to fail, or are they safe to fail?
Right. So they are dependent on financing from traditional banks. Data is somewhat limited to fully understand it, but regulators have some of this data. But I think there are really two aspects to this. One is a direct exposure of traditional financial sector through warehouse credit lines and other lending to shadow banks. But I think I would also don't discount the second effect. Suppose these warehouse credit lines are reasonably safe, but the shadow banks, because of the crisis, concerns about the quality of their lending, which is much lighter supervised right now, just stop lending. When you stop lending, what's going to happen in the marketplace? Well, obviously, we can have a price effect. It might be harder to finance a home purchase or refinancing, and that could spill over on the rest of the economy as well. So there's this direct risk to financial stability through the exposure of traditional banks to the shadow banks through the credit lines and other things they provide to them. But I also wouldn't discount the fact that if you have a market like FHA, when 85% of loans are made by non-banks, and say they just stop lending because there's a concern, the traditional banks just cut financing because they don't want to finance something that might be subject to regulatory scrutiny or lawsuits from FHA or something like that, then essentially they stop lending, and suddenly these millions of borrowers cannot get credit. And now who's going to give them the credit within a month or two time? Or will the traditional bank be willing to say, okay, we're going to pick up the slack? Maybe, I don't know. But you could see that this could spill over on the rest of the economy fairly quickly, the way some of these things spill over in 2007, because the crisis started in subprime, not really in the prime sector, but were very quickly spillovers through the house price effect, immediate collapse of refinancing volume, purchase volume, and a relatively small drop in transaction. Say liquid asset class can have a pretty big pricing effects, and at least in terms of if you want to quickly sell, might be much harder to do it.
I want to build on one part of the other intersection, not dependent on their financing relationship, which is if someone can digitally target and have a better understanding of how to more accurately price, they no longer have to acquire all of your customers. They can just acquire your most profitable customers. Yeah. And what we look at, right, the cycle of life in banking is you start with a small bank, you grow it into a multi-branch bank, it gets acquired by a slightly bigger bank, it gets acquired by a regional bank. The founders say, I don't know what else I'm going to do. I'm a banker. Let me go start another bank. The cycle just goes on. Someone's always willing to acquire, and we don't see much in the way of bank failures anymore in that regard. Someone's willing to price it. But what happens in a world where you're seeing your costs, your fixed costs are fixed. You have rising costs around a lot of your OpEx, especially related to compliance. But now you're seeing the key segments that were actually very critical to your pricing the basket get picked away, right? And that becomes actually another way that those two things intersect.
So that's kind of your last slide, that one slide you had, which I think it's we ain't seen nothing yet. Mm-hmm. And with that, I think we're out of time. So I'll hand it back over to Diane.
Okay, thank you, Meg, Tomasz, Tetyana, and Jason.